Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. stocks, TSLA holds midfield, SOX, SMH breakdown update, AMD turns the tide, HD maintains guidance, 30-year Treasury yield approaching 2007 highs. This video presents a direct informational narration of the source document. Let's dive right into today's explainer.
Right off the bat, if we look at the major indices, we're seeing some continued sluggishness out there. To give you a picture of what's happening under the hood of the S&P 500, we've got 317 declining components up against just 185 advancing ones. And looking at the 11 sectors, 6 are down, 5 are up. But here's where it gets interesting. Juxtaposed against all this broader market weakness, the healthcare sector, which we track via the XLV, is showing some real intraday resilience. It opened with this immediate upward push and actually sustained those levels all day with almost zero retracement. It just held the line beautifully.
So what's the roadmap for XLV looking like? Well, it's established a really solid structural base right above that 147 mark, and that's backed up by 2 consecutive underlying levels. If we're mapping out the medium-term upward resistance targets, we're looking at 149, then 152, 153, 158, and eventually climbing back to its previous highs. What this tells us is that we've got a solid setup here for a defensive allocation. It's a great spot to look at if you're hunting for areas with a bit more muscle to resist all this broader market volatility we're seeing.
Now let's pivot back to the broader S&P 500 for a second, because the picture here is quite a bit different. Despite seeing a rapid intraday rebound, the index ultimately closed in a pretty unfavorable position. It dropped almost directly after that surge. And you know what happens when we see that kind of price action? It traps a massive amount of that rapid rebound volume right up at those higher levels. Moving forward, this significantly increases the overhead price pressure. Basically, it creates a much heavier forward resistance that the market's going to have to chew through.
Shifting gears to the macroeconomic side of things, because we absolutely can't ignore the catalysts here. Brent crude has blown right past the 110 level and it is staying elevated. A big part of this, mediators are noting minimal, if any, progress in the Iran-US negotiations. This is keeping market fears totally alive regarding a potential restart of regional conflicts. And you know the drill. With oil prices hanging out up here, the market's collective focus is shifting right back to inflation. And speaking of macroeconomic pressures, we have to talk about the bond market. The 30-year Treasury yield recently hit 5.19%. That is dangerously close to the 5.3% high we saw right before the 2007 financial crisis. But here's the kicker. Back in 2007, global macroeconomic debt conditions were much, much smaller than they are today. To add even more fuel to the fire, global hawkish expectations for base rate hikes leading into 2026 have spiked up to a staggering 80%.
It's not just the 30-year causing a stir either. The 10-year Treasury yield just recorded a massive single-day increase of 1.56, tearing right past standard warning levels and heading toward that crucial 5% threshold. So why does this matter? Well, if that global benchmark rate actually hits 5%, it's like a heavy blanket being thrown over the market. It creates severe downward pressure on both global economic conditions and, crucially, equity valuations. All this puts the Fed chair in a really tough dilemma, trying to balance stable unemployment data against these soaring yields. Historically, lower yields didn't drastically hurt the stock market. But man, has that dynamic shifted. Get this. The current 30-day rolling correlation between the S&P 500 and 10-year yields has plunged to negative 0.6768. That is literally the lowest benchmark we've seen since September 1999. This escalating negative correlation is a huge indicator showing that higher yields are exerting an increasingly fierce downward pressure on stock prices. Okay, let's step away from the macro data and check in on corporate earnings. Home Depot just reported their Q1 numbers. Adjusted EPS came in at $3.43. Now, that is down from last year's $3.56, but it actually beat the street's estimate of $3.41. Revenue looks solid too, growing 4.8% to $41.77 billion, which also topped the $41.59 billion estimate. Looking ahead, Home Depot reiterated its forward guidance for fiscal year 2026, projecting flat to 2% comparable sales growth and flat to 4% EPS growth. Essentially, they're telling us the demand environment remains pretty much unchanged from last year. So how do we map out Home Depot's forward valuations based on all this? For January 2027, the range sits between $258 and $431. Moving out to January 2028, we're looking at 281 to 469, which gives us a median target of 375. If you're looking at this for long-term allocation, keep an eye on some notable support zones, specifically between $282 and $306, and then a deeper value zone down at 263 to 277. Overall, this slow growth forecast really reflects the ongoing drag on home improvement spending, which is exactly what happens in a high interest rate environment like the one we're in now.
Moving over to the technology sector, we observed some really distinct rotation dynamics today. Microsoft and the broader software group showed a lot of early strength, but as the day went on, semiconductors caught a bid and rallied late, leaving Microsoft in more of a lateral consolidation. Though, to be fair, its upward trend is still perfectly intact. Now, AMD was a bit of a wild ride. It experienced some real volatility, dropping to a low of $393 before aggressively rebounding to defend that critical $400 support level. Keep a close eye on this. If AMD breaks below 400, the next major breakdown support doesn't hit until 366.
Tesla, on the other hand, showed some serious relative strength. It managed to fiercely defend that $380 to $405 range and actually closed right near its daily highs. It did a great job maintaining its position above its structural upward trend lines, preserving both the daily and weekly Bollinger Band middle lines. If these technical boundaries hold up, we're looking at the potential for a solid technical rebound here, with the next chunk of overhead resistance sitting in the $420 to $465 range.
Then we have Google, which has been making some major strategic moves in AI. They just announced a partnership with Blackstone that's going to utilize Google's TPU chips for a brand new AI cloud venture. Plus, they revealed some highly anticipated AI video models over at their I/O conference. On the technical side of things, Google is currently consolidating right at a major support zone between $375 and $385. Just keep in mind, valuations pushing above that $400 mark are widely considered to be pretty stretched right now.
Given all this elevated volatility we're seeing, especially the speculative swings in semiconductors, let's map out the immediate structural levels for the broader indices. For the SPY, we're tracking support down at the 728 to 735 level, with resistance now recalibrated up to 738 to 743. As for the NASDAQ 100 ETF, it's currently showing support between 688 and 696, but it is staring down some much heavier overhead volume resistance, right between 700 and 715.
Speaking of those semiconductors, let's look at the technical breakdowns in the space. The SOX opened lower at 484, which effectively establishes a whole new resistance zone for any cautious technical rebounds at 489 to 511, and then again at 521. Similarly, the SMH dropped straight through its previous gaps, which completely recalibrated its own resistance level down to a 535 to 565 range. So definitely a heavier overhead environment for the semis right now. To really understand what's happening with those semiconductors, we need to look at market breadth. Out of 30 components in the semiconductor index, we saw some notable dispersion. 18 declining components versus only 11 advancing. This kind of fracturing signals a clear dissolution of correlated price action. The sector is just no longer rising and falling as a single unit like it used to. What does that mean? Well, it's a strong indicator that speculative capital is actively reducing and retreating from the broader space. So, where does this all leave us? We've got Treasury yields absolutely surging and tech breadth completely diverging underneath the surface. The resulting market friction brings us to one absolutely crucial question as we wrap up this explainer. Will NVIDIA's highly anticipated upcoming earnings be enough to step in and stabilize this entire tech sector? Or are they going to be the catalyst that triggers a much deeper structural breakdown? We'll just have to wait and see.